Hello, active traders, and welcome to Trading Success Strategies with myself, Ken Calhoun, and my longtime colleague, Bennett McDowell from TradersCoach.com. It's great to see all of you here. As a reminder, all information is for educational use only. We're not making advice about what to buy, sell, or hold. By watching this, agree not to make actual trades. We are recording tonight's event, and so you will get a replay. And just a reminder, Bennett is from TradersCoach.com. Highly recommend them. He's one of the longtime, highly respected educators out there in the industry. So great to see him and all of you here for today's live event. We will not have time for Q&A, but we do want to make sure that you do have a chance to see our information. So I wanted to welcome you aboard, Bennett McDowell, and great to see all of you here for today's live broadcast.
Ken, thanks so much. It is great to be here. Everybody should now see my screen in front of them, so we'll go ahead and get started. Ken, I just want to say it's great to be on again. Ken and I go way back, and we have a good time trading and sharing stories. Always great to be here, and it's great to be talking to your group, Ken, as well. So thanks for having me. All right, today we're going to talk about Elliott Wave. I'm going to focus on some specific strategies. A lot of people talk in general terms when they talk about the Elliott Wave. But today I'm going to show you some of my favorite setups, and we're going to be together for about 30 minutes, and then Ken's going to come and talk about some breakaway gap setups that he likes to trade as well. So let's go ahead and get started. Ken already did the disclaimer here. So in this case here, I'll basically just say there's risk in trading, but you know, without that risk, I always say there is no opportunity. So the two really go hand in hand. All right, and again, Ken introduced me, and Ken, thanks for showing everybody the website. We always welcome everybody to come over to our website and say hello and check out our stuff. We got a lot of free stuff over there as well. You may have seen me by reading one of my books available at Amazon. I have 4 out now. We're going to focus on the book on the right, The Elliott Wave Technique Simplified. But I have books on money management, how to run your business like a hedge fund, and trading systems as well. So take a look at these on Amazon, and you can read all the fun remarks. Now, because you've taken the time to get here today, we wanted to give everybody a free Elliott Wave cheat sheet that has the stats on it and all that kind of fun stuff. So there's the link there. Now, Gene's going to put that link, I believe, in the chat area, so you could just click on it from there. So go ahead and look for that in the chat area and click on it. And basically, it's a 6-page PDF download for you. And it's clear definitions of each Elliott Wave characteristic. And I use this, and I have it right on my desktop all the time. It's super. We give you illustrations of what the patterns look like on a chart. We have tables with Fibonacci target zone analysis for all 5 waves. And it's easy and clear. It's simple. That's the purpose of it, is to get these rules that can be quite complex. We've simplified them. So they're on that cheat sheet. So please download it. It's yours for free for being here today. And we appreciate you, of course, for being here. All right. So a little bit on the Elliott Wave. Before I get started, how many people out there are familiar with the Elliott Wave? Just out of curiosity. Because sometimes when I do these webinars, we get some people that are very familiar and some people not so. All right, good. So I'm seeing a lot of the answers coming in. I know you can't see that there at home, but we have some people that are and some people that aren't, and that's pretty common. So let me start with the beginning here of who is Ralph Nelson Elliott. What is this all about? Well, actually, Ralph Nelson Elliott actually is one that observed that there were waves in patterns. There are patterns in these trends that we call waves. And he was born in 1871. He was actually an accountant, and he almost died in 1929, believe it or not. And after he recuperated, he changed from being an accountant to actually turning to the financial markets, and he got to where he really started to get involved in it. He studied the stock market and the Dow theory in 32, and he also revealed the wave principle in 1938. And he finally came out with a book called Final Works Nature, published in 46, which actually was a big hit. And then unfortunately he died in 48. They didn't quite live that long back then compared to how they do now. But the interesting thing about Ralph Nelson Elliott was that he observed that in a trend there are 5 waves. And basically it's called observational statistics. And what do I mean by that? Well, basically what I mean is that he didn't really know at first why there are 5 waves in a trend. He just observed them. It's kind of like, and this is a great analogy I like to use, is astronomers, when they look at black holes, they have really no idea how they really work, but they know when matter gets a certain distance from that black hole, it gets sucked into it. And they really don't really know where it goes. That's an observational statistic. And so you can see something and you can get a probability of what will happen when that something occurs, but that doesn't necessarily mean you know why it's happening. And so that's where Elliott was when he first discovered the Elliott wave. And I think it's kind of important to realize that, because a lot of people will want to know why it works. Sometimes the more important question is, how often does it work? So why use the Elliott wave? Well, for one thing, it's great at forecasting price movement for profit, and we're going to show you that. It encompasses mass psychology and puts it into a form of technical analysis. It tells you what market cycle or wave you are in. We can establish price target zones by knowing the wave patterns, and therefore also lend itself to calculating risk and reward expectations. So we really call the Elliott wave the roadmap of the markets. And the Elliott wave principle is a form of technical analysis. It's not fundamental analysis. It is technical analysis because we're actually using price patterns on charts to analyze these particular waves. And they're used by traders and investors to forecast trends in the financial markets, as well as other collective activities. The wave principle states that collective investor psychology, or crowd psychology, moves from optimism and pessimism and back again. These swings create these patterns as evidence in the price movements of market at every degree of the trend. Elliott's model says that market prices alternate between 5 waves and 3 waves at all degrees. And the 3 waves, of course, are our corrective waves. So we're going to take a look at that as well. Now here's an example of Apple stock here. And one of the points I'm trying to make with this is that we've got a whole bunch of numbers here. So we got a 1 up here, we got a 2 here, we got a 3 here, we got a 4 here, and we got a 5 here. So here's an example of 5 waves in a trend. It ended at 5, and then the market broke to the downside. Now, inside waves 1, 3, and 5, there are 5 waves inside those. Those are called impulsive waves. And so there are 5 waves, and we've labeled them smaller down here. Here's a wave 1, here's a wave 2, a wave 3, wave 4, and then it finishes at a little 5 up here. And then we have those 3 waves, ABCs, and the corrections, and then it starts over again, 1, 2, 3, 4, 5. So there's 5 waves in 3, 5 and 5, 3 and 4. So the important thing is that when we look at something like this, sometimes you can't always see the waves inside the waves, but if you go to a smaller time frame, they become much more visible. So every pattern's a little bit different, but there are always these waves inside waves. So to take away from this, there are 5 waves in a trend. 1, 2, 3, 4, and 5. Likewise, if this was a downtrend, same thing. Okay, again, 5. 1, 2, 3, 4, and 5. And when you get to the end of 5, that's usually the end of the trend. And what we usually do with this is take a look at what we call Fibonacci retracements, which I'm sure, and extensions, which I'm sure everybody is familiar with. And if you're not, they're very easy to use. But we usually attach a fib retracement, okay, between 2 and 3 to get where wave 4 will end. And then once we have wave 4 in place and prices come down and then rebound back to the upside and begin wave 5, then at that time we can do an extension and anchor it at 3 points to get the target level for 5. So we'll show you some examples of that as well. So that's how we can establish price target areas for wave 5 and wave 4 using the fib extensions and retracements. So we do use fib along with Elliott wave analysis. All right, let's go to our next chart. Now, what I described already and what Elliott noticed was what we call classic Elliott wave theory. But there's something else now out there called modern Elliott wave theory. And modern Elliott wave theory basically came about with the advent of all these powerful computers that we have available now on our desktop. And what it does is it allows us to look at the momentum inside different waves to give us a higher accuracy of the wave count. So let's take a look first and go over classical once again. Here's an example of a chart, and inside, once again, here's a monthly chart, and notice that we have 1, 2, 3, 4, 5. Okay, then it goes into an ABC. Now here's a longer term chart called a yearly chart, and what they've done is taken the red number 1 and transposed it on the yearly as well as the 2. And so that 1 and 2 from the monthly chart represents a cycle inside a longer time frame, also moving up. And then they do that also for a 5-year chart. So this again establishes the fact that there's waves inside waves, and when you use market time frame analysis, all right, where you have one time frame, let's say a 60-minute on the left side, a daily on the center, and a weekly on the right, you get a very good idea of how all the waves interact. And of course, you can use this for day trading too. We do that all the time. All right, and again, just another example of the waves inside of waves. And you see they can actually look, the patterns can look quite different. You know, trends don't always go straight up. They do these zigzags, okay? And sometimes, you know, if you didn't label the waves, it would look like a mess. But a lot of times when you get into measuring the momentum and measuring the retracements and so forth, it becomes quite clear what the wave count really is. And here are corrections. These are called zigzag corrections. These are your waves 2 and 4, for example, and they are ABCs. And in here, look at the little itty bitty waves inside the A wave. There's 5. 1, 2, 3, 4, 5. So A wave is an impulsive wave. Anytime there are 5 waves in it, that's called an impulsive wave. And B and C. So there's always waves inside waves. Now, the major criticism of Elliott wave is that many feel it is subjective. And to be honest with you, if you really don't know what you're doing, it is subjective. It can be very confusing. So our goal here is really to take the subjectivity out of wave counting. And this is where the modern approach comes in and really helps us do this in a really great way. So I have a little thing called connecting the dots here. And it's a result of combining both classical and modern approach to increase your odds of success. So let's take a look at some of these key components. We got the classical approach, of course, that's looking at price patterns, Fibonacci levels, and so forth. Then we add in some indicators to help us look at momentum. And we have one called the optimum wave locator that helps us do that. We have some indicators as well that are standard on the package with certain settings. And then we take a look at the actual pivot points or fractals in the market, because they help us actually identify these points in the market where the waves turn. We look at volume. For example, we have the highest volume in wave 3 as compared to any of the other waves. And by the way, momentum is highest in wave 3 as well, and there's always bearish divergence between the momentum in 3 and the momentum in 5. We look for price channels. You ever see pennants? How many people out there know what pennants are? And flags and things like that. Of course, right? Well, did you know that most of the pennants and most of the flags form in Elliott wave corrections? So if you see one forming, it's in a correction most of the time. And it's usually in wave 4. All right, and then I put together what they call a probability matrix. And this is where I assign a percentage to each one of these components to get an accurate probability of the wave count. And so we go into great detail on that. And then of course, there's always risk control that we use as well. So when you connect all these dots, you really take the subjectivity out of the Elliott wave count. And I think that's really important. Now, one of my favorite strategies, I got a couple, but one of my favorite is catching wave 5 breakouts. And Ken's going to talk about breakouts in just a moment. But the purpose of trading this pattern is to get in early enough just after wave 4 ends to ride the entire run of wave 5, okay? You must get in early, so you lock in profit before wave 5 reaches its target zone, which is when the trend will change again. That's really important. Also, you want to get in early enough so you can set your stop at the bottom of 4 and just leave it there until the market starts to become profitable. Then we have a whole scheme of how we move stops up. All right, you can scan to locate opportunities for catching wave 5 setups. And when you do, here's a step-by-step instructions on how to enter the trade on a bullish trend. Identify the most recent bullish wave 3. Wave 3 is always really easy to identify because it's the most powerful wave. It usually has the greatest slope, whether up or down. And again, it has the highest volume and the highest momentum. So it's very easy to find it. That's another reason why I like these wave 5 trades, is because when you see wave 4, then you expect to see a clear wave, when you see wave 3, rather, you expect to see a clear wave 4 after that. And when you do, that's the setup for wave 5. All right, we draw Fibonacci's for these high probability target zones as well. So we're gonna take a look at this. So here's a chart, and give that a second to show up on your end. And in this chart here, you can see that, look at the slope of this wave 3. Huge compared to the other waves. We had a 1, we had a 2, but the slope of 3 is the biggest. Now notice here, this is what we call the optimum wave locator that we use to actually measure and label wave 3 on a momentum basis. So there it is, labeling that 3. It makes sense with the price structure. So then when the market starts to falter and this indicator down here goes south, okay, and goes below the 0 line like it did here, that's your confirmation that we were in a wave 4 at that time. So then you run and grab your fib retracement tools and draw it at the bottom of 2 and 3, and that's going to give you your high probability target zone for the retracement of wave 4, which is between 0.382 or 38.2% and 61.8. Okay, so that's key. All right, so if it reaches the target zone and we see momentum coming back like we saw here, then that's a good indication that we have begun a climb out into wave 5. So again, why I like this so much? Because they're so easy to see. Once you see 3, you look for the ABC correction. In 4, bingo. Wait for it to climb out, break some support levels on there, and good to go. And then put your stop at the bottom of 4. It's that simple. If you don't see a clear 3, move on to another chart. Okay, very simple when you break it down like this. Let's move on to another. All right, so here's some of the things that we look for. We wait for a bearish correction, like we said, the wave 4, that retraces into the Fibonacci high probability wave 4 target zone. And again, those numbers are 38.2 to 61.8%. And if the retracement does not reach the high probability target zone or exceeds 75%, then do not trade it and instead move on to another market, because that's not a wave 4 then. If it doesn't reach in that target zone and then climb out properly, it's not a wave 4, okay? So they have to reach the target zone, and then it has to have a bullishness to return. And the price oscillator, which I showed you that measures momentum, needs to also be bullish after wave 4 for you to take a trade. All right, so more rules. Next, draw in the Fibonacci 5 target zone. So we'll take a look at that in a moment. And we anchor wave 2, 3, and 4 for that. And then wait for a higher low and a higher high after wave 4's low for initiating a trade. Okay, this is all the stuff we went over on the previous chart. So let's go here right to the chart and take a look. So if we go back here, all right, here was how we got wave 4, those 2 anchor points. and then we saw the ABC. We have a clear wave 3. Notice we have a wave 3 on the momentum. Notice momentum went below the 0 line here. That's 4, and then starts to climb out again on 5. So that's important. You don't want to take a trade until the wave 4 negative histogram goes positive. That's step 1, okay, in taking the trade. Then what you want to do is you want to make sure that you start popping some of these support levels. And if you get a little pullback like you got right here, all right, and then it exceeds again, that's also, here's one right here. Those are also excellent areas to take a long trade, but only if the momentum has turned bullish. So that's important. Now, the next thing we want to do is, before we take the wave 5 trade, is see what the target zone is for wave 5 to see if it's worth taking. So for that, we use Fibonacci extensions and we anchor those on 2, 3, and 4, and that gives us a target zone here between 61.8 and 100%. That's your high probability target zone where 70% of the wave 5s reach. And so then you have an area now that you're shooting for. Okay, it's very important when you take a trade to kind of have an area of where you're going rather than just take the trade, right? So that's important. So that gives you a quick synopsis into how to trade wave 5s and why I like them so much, because they're so easy to do once you have a clear 3 and an ABC 4. All right, here's one. Here's a flat bottom wave 5 breakout. It went into a complex correction where we had a pennant and then it popped out here, okay, and then took off into a wave 3, a major wave 3 after that, okay, and then a wave 4 here, and the next wave will be our wave 5 trade. So here's a flat channel market, pops out, we get wave 3, ABC, we had a pennant on this side, and then it took off, okay, another great one. All right, so for catching wave 5 strategy on a bearish trend, the method is just reversed. We looked at uptrends, but it's also reversed on downtrends. And so it's very simple. All right, I also want to share with you, because I want to get finished here before the half an hour. I want to share with you the Dow Jones Industrial Average right now. Okay, this is a current chart on the Dow. Let's take a quick look at this. All right, so this is a daily chart, and notice I've labeled wave 3 on this chart here. Now, wave 3, all right, has been going on for quite some time, so it's a mature 3. And notice we have bearish divergence building here in the optimum wave locator. So prices are making higher highs, but the momentum is not. That's classic example of a trend that's becoming mature. Now, just because you have bearish divergence doesn't mean you should short this. Simply, the reason for that is simply because bearish divergence or bullish divergence can last a long time. So you want to have other reasons to actually enter the market. So in this case here, this is a 3. Now, remember I said there are waves inside waves, right? So let's take a look at the next slide. And here's the 60-minute chart on that same market, the Dow Jones Industrial Average. So now I'm looking at a chart where each price bar represents 60 minutes instead of a full day. And notice on this chart, we have 3 here, 4 here, and we're climbing up to a wave 5. So here's another one of my favorite wave 5 trades. And notice we had the breakout here, okay, after it cleared some of these support levels. And notice here we had a little bit of a negative here coming down, all the way down here was predominantly negative, and then now we're popping back up. So again, you don't want to go long until this indicator here is green and you start taking out some of these support levels that you had on the retracement. Then you're good to go and your stop can go right under the bottom. And here's your target zone right up here. So if I can take a minute of your time here and just go to our next slide, then I'm going to come back to this. I want you to remember this configuration. And then I want you to also remember what we saw before, and I'm going to go back to that real quick, on the daily chart. So we're in a 3 here, and we're in a 5 here. So when we get to the top of 5 here on this shorter time frame, because there are waves inside waves, that's going to be the final top for wave 3 on the daily chart. So our target range is 22,179 up to 23,325. and that's our target range for the 60-minute chart, which probably will be more than likely of high probability target area for wave 3 on the daily chart. So we still got some movement up. Let's take a look at this now real quickly. And let me just draw this out. So remember, waves within side waves. So here we are, we're climbing up. We start here, 0. Here's wave 1, 2, 3, 4, and 5. So the waves inside waves of 3, we'll focus on this, is 1, 2, 3, 4, 5. Now, if you remember on the daily chart, I said we're near top of wave 3. But on the 60-minute, I said we have just finished 4 and we're going up into wave 5. So we're probably right about here in that whole Elliott wave count. So therefore, when you look at lower time frames like the 60-minute and the daily in this example, even on just the Dow, you can certainly see how that helps to pinpoint where you are in 3 and also where the market will top in terms of probability on wave 3 for the daily and wave 5 for the 60. So that helps us. So you can go inside these waves and trade wave 5s inside those as well. So I just wanted to kind of make sure you kind of get the relationship between the wave 5s and the wave 3s. Now, if you want to learn more about this, we have 2 places you can go. One, you can get the book, The Elliott Wave Technique Simplified. I also have a Master Series home study course that's available on our website as well that may interest you too. And we teach you how to draw all the fibs and everything like that. So this is available at Amazon or any of the major bookstores in your area. So again, what I'd like you to do for today is download this free cheat sheet, okay? I think that's really important for today for you to get started and get familiar with this. And then, you know, play around with the concepts that I just went over, and I think you're going to find that that takes the subjectivity out of the Elliott wave for you. So I want to thank everybody for attending today. And again, I want to thank Ken for having me. Really great to be here. I always like presenting and talking about the Elliott wave. I think it's such a cool concept. Okay, so that rounds out my session today. And Ken, I'll turn it back over to you.
Hey, well, thanks so much, Bennett McDowell. Highly recommend Bennett and his team at traderscoach.com. I was taking notes. I really like your analysis of the Fibonacci price extensions and how they integrate with Elliott waves, and also the nuance about looking for pennants and flags on wave 4. That's one thing I hadn't been familiar with on E-Wave. So thanks so much. Really smart, intelligent, well thought out presentation. So well done.
Well, thank you, Ken. Great. I'm anxious to hear what you have to say about breakouts too.
Well, thanks. It's always good to combine multiple techniques for everybody. And again, wanted to thank Bennett McDowell and Jean from traderscoach.com. Highly recommend you go take a look at their site. I'm Ken Calhoun. I run trademastery.com, and you're certainly welcome to participate in my free Saturday events. Every single Saturday, we got over 4,200 people who registered for those. Let's go ahead and get into it. One of the things, before we jump into I've got just a few slides. I want to go over some rock star charts for you guys. And one of the things that so many thousands of traders have learned from me over the years is the difference between good, strong, tradable trending charts like PayPal, right? Ka-ching on gap continuations and everything else. And one of the things that I think can really help your trading success is to know the difference between tradable charts that you could pretty much throw darts at them and make money potentially compared to the choppy charts that so many traders have trouble with. So whether you're day trading or swing trading, you're looking for, this is a 3-month daily chart, or if you're looking for shorter term, this is my weapon of choice, my 15-day, 15-minute candlestick chart. We like to look for these patterns. And kind of like wave theory, if you got breakouts, consolidations, breakouts, resting, stair-stepping patterns that run up, it really makes a lot of sense to look at how those compare to other charts out there and what kind of trading opportunities they set up for you. So we're going to look at these charts and more in today's event. We're also going to take a quick look at how to use the average directional index. I've published on this and used this in my own trading for nearly 20 years. Wilder's ADX, you may have seen my articles in stocks and commodities or equities or my money show appearances. The quick writer downer is ADX with the standard default setting of a 14-step parameter, I decolor the DMI line, so all I use is the red line. Once it breaks over the 40 for stock swing trades, buying 50 cents above the high of the signal day generally leads to a good breakout continuation ahead of time. And it's the only oscillation indicator other than the 50, 100, and 200 simple moving averages that I use in my own professional trading. So we're going to take a look at some rockstar charts today. Wanted to welcome you all here. I've traded as much as 4.1 million in verified trades in a single year. Not profit, only I think it was like 16 or 18K profit on that, but I still traded as much as 4.1 million in order flow in my Interactive Brokers account. So I like to trade real money. As always, all information is for educational use only. You may have seen me in TheStreet.com, CBS Market Watch. I'm a UCLA grad, former corporate statistician for the Ford Motor Company. I'm a regular columnist in my Trading on Momentum column in Stocks and Commodities every single month, a new breakout strategy, so recommend that. I've been around since, like Bennett, since the dawn of time, since dinosaurs walked the earth. We've been around for a long time. 2001, I was back in Market Watch. So anyway, I'm glad that the world's traders trust me and people that I work with and trust, like Bennett and Larry and other people who are good to work with. So what you'll learn tonight in the next 25 minutes is finding successful trades, difference between the kind of charts that I like to trade and everything else, strongest day in swing trading charts, and risk management and scaling. The number one thing that I want you to learn from me tonight is the most important indicator is the P&L indicator. And what I mean by that is the math is a lot more important than the chart patterns. When it comes to extracting money out of the stock market, you're going to get probably at least half your trades are going to go sideways or down. So how do you make money in spite of that? Well, you use position sizing, as my colleague Van Tharp would call it. You use scaling. Use tight risk management. We're going to go over some strategies for that. Finding successful trades. Strongest day in swing charts are going to be minor gap continuations. We just looked at a couple of those. We're going to look at more. Multi-day high breakouts. I always do sequential entries every couple of points for swing trades. For intraday trading, I like to use gap continuations and 2-day highs. And also entries following wide candle days. I've worked for over 15 years with Steve Nissen, and so he's the go-to guy for candlesticks. I like looking at momentum candlestick charts and how they work, and we're going to look at some examples of that tonight. So that's it for my PowerPoints, except for a wrap-up slide I'll show later. Let's jump into the chart, shall we, and see where the money's at. Start off with a 90-day chart and look for charts that have a minimum 10% high-low range. That's one thing. So a $40 stock needs to have at least 4 points of range. Anything less than that, your risk reward numbers aren't good. So anything that's above what I call a highway of gold, or you got your 50, 100, and 200 simple moving average, I can't resist coming up with occasional clever titles. I like copy. Anyway, good continuous uptrend. One of the things that I want you to visually look for as a professional trader are not only cup pattern breakouts as they occur, but also the texture of the slope of the line once it starts to move. And one of the techniques that I pioneered decades ago is called acceleration ramps. And that's simply where you eyeball a chart and you get a chart pattern that goes from a steady uptrend to a higher volume, higher price action breakout continuation, kind of like a hockey stick. And you can see this. See how the volume lifted up in applied materials. All of our chip makers have been strong lately. AMAT's been one. NVIDIA's one that's been in the news a lot lately. I like trading things usually between $20 and $70 a share. One of the things that you may run into trouble with, and a lot of misleading information out there, is things like penny stocks or cheap $3 stocks. I think those are for morons. I think professional traders like myself, we all like things, usually, I don't like the really expensive high flyers. I like things, my wheelhouse is 20 to 70 a share, and I've published on that for years, and that's what I like to trade, nice, clean, breakout, continuous charts that make sense. So what I want to cover right now is some of the visual price action patterns that make sense to trade, and also the value of things like sector trading. Here's Delta Airlines, current chart. Here is Hawaiian Airlines. It broke out today or yesterday nicely. Here is American Airlines. You can see they've been buying airline stocks. The two of the strongest sectors right now are airliners and semiconductors, and so it makes sense to focus your energy strategically on strong sector instruments. The tool that you use to do that is simply, it looks like banking was hot today, but not so much in a long trend. Semiconductors have been on fire for the last 2 months. Knowing how to zoom in on the right sectors helps dramatically improve your hit rate or your potential success rate because you know where the institutional money flow is going. So what I want you to do, let me just be step by step, is put together a small quote box that has a handful of sectors. Like I like to trade insurance stocks, semiconductors, finance, banking, biotechs. I trade oil and gold, in pharmaceutical sector. Whatever sectors you trade, make sure that you've got them and you are on occasion, at least a couple times a week, click through your sector charts and see which ones have discernible trends. Those do not. Semiconductors do, right? So that's one of the strongest trending sectors. Make sure that, as you're looking at your S&P and you're looking for what the broad market's telling you, here's our S&P. It's hovering at support on the 50. We're currently trying to make another bullish cup, a couple of doji here today and yesterday, so we don't have any strong decisive breakouts in the market unless we take out new highs. What you want to look for is exceptional strength, relative strength in those sectors that are likeliest to get better institutional money flow. So, for example, here this tells me the semiconductor sector is the best, kind of the fishing ground to go in. So trading the right instruments is half the battle. At least half the battle. Using real tight stops with tight instruments is the other half. Here's another quick candlestick pattern that I like, is if you see a lot of bullish lower shadows, like all these bullish lower shadows, this is not a hammer. It's not at the bottom of a downtrend. It's poking its head up here. But when you see a lot of bullish lower shadows, if you were to make data points out of these daily points, these would be small bullish cups, which is good. So this tells me I may want to look for a long in ILG at a new 5-day high, preferably, though over the 90-day high. Because this guy went from 18 all the way up to 28. It got a 10-point run before softening up. It's not a good idea to try and bottom fish or do a dead cat bounce. It's better to buy strength. One of the tips that I will share with you is that it's always a smart idea to use what I call a false breakout filter. So for example, JD, kind of a bearish pattern today, right? It gapped up, it filled the gap down to the previous day's high, right? Which is no surprise. I always use a 2-day, 1-minute chart for my day trades because it shows me with lightning-like precision or Swiss clock-like accuracy previous support and resistance regions. So I called this guy short in my live room today, which was good, and we called the cover before it hit the support line at the previous day's high. For a long continuation, one of the tricks of the trade that I learned the hard way, and I've done thousands of real money trades, is that the obvious dumb money breakout is going to cause an epic fail, and you're going to lose some money there, son. Boom! Just say no. Stop the madness. Don't buy new highs. That's stupid. Trade new highs plus a false breakout filter of a minimum of 50 cents for a swing trade and a minimum of 30 cents or so for a day trade. So here's a bullish cup. The newbie traders would have bought the first sign of a breakout. Hey, it's running. Then, holy crap, Batman, I don't think so. I get stopped out. Epic fail. Face plant. That ends badly. Of course, I called it short because I'm a trader. I know how to trade. But what you guys want to do is set a false breakout filter above a high of a minimum of standard default. If I already do kind of spreadsheet trading, I use 50 cents above the nearest whole number for a swing trade. So although not a technical trading recommendation, I'll be looking at a long in JD if it breaks over what? Who can tell me? I used to be a corporate trainer for Ford Motor Company, McDonnell Douglas, Rockwell, Sheraton. A lot of big companies trusted me, which I appreciate. Now thousands of traders trust me. This is the part where you put your thinking cap on. If we wait until 50 cents, I used to teach MBA courses too, so I'm a professional trainer as well as trader. If you wait until 50 cents above the nearest whole number, your long trigger for JD is going to be earliest where? The newbie traders are going to buy, say, 44 and a quarter, and it's going to stall them out, and it's going to drop, and they're going to get stopped out. And then just to rub salt in the wound, it'll run to 50 without them. I used to be that trader. I've made every mistake known to man. And then some. I screwed up every which way but loose, which was a good movie with Clint Eastwood, but I digress. Anyway, no, epic fail. R.O. and Dan, nice try, but no spaghetti and pizza for you guys. 50 cents above the nearest whole number high would yield an entry trigger for a long at where? An entry trigger for a long is where? And it's not where my arrow's at. An entry trigger for long, I'm a professional breakout trader, so what I do? 44.50, right? That's 50 cents. I mean, come on, guys. I know I used to be a statistician, so I could talk all about design of experiments and Taguchi loss functions. and process capability charts till your eyes glaze over, but we don't want to go there. Simply, the trick is use a false breakout filter, anticipate that they're going to try and fake you out. There's going to be a little fake out, not a breakout, right above resistance. So minimum of 50 cents above the high before you get in on a long trigger. That would have kept people out of trouble on a swing trade here. And for a day trade, minimum of 30 to 50 cents. In this case, the nearest whole number is 44. So you'd wait till over 44 to go long in a gap continuation on that chart. Okay, so those are some of the nuances or tricks of the trade that you learn after making every mistake and then make successful trades. You learn the difference. Another one of my favorite patterns is a tall green momentum candle. And I just did a podcast with Steve Nissen back on this last Monday, and we're talking about these because this is my favorite momentum candle. Is a large green candle at the right side of a bullish cup. Other educators have since ripped off my techniques and stuff, but anyway, I originated this tall green candle at the right side of a cup or congestion box concept. And again, 50 cents above. Again, odds are you're going to not see it on this day. You know, as a swing trader, let's do the old time-lapse photography trick. Tick tock, tick tock. Odds are you're going to see it that night. You're not going to see it the day of the breakout unless you're a day trader and you're seeing it live. Add 50 cents to that, and that's your trigger, and it goes up from there. So look for large green candles, but at least 30 to 50% taller than the average whole real body height of the previous week's candles. You'll see these big candles, either a gap or a breakout pattern at a new trigger. Now, yeah, Dan got it, so hey, cool. What else do we have? Good charts worth trading. Gap continuations, or large green candles at the right side of a cup, usually worth taking a shot at. And again, I'm a price action trader. I'm keen on using price action. I don't use a lot of derivative technicals other than moving averages. I use the height to the whole real bodies of the candles. I use volume and price action are my two key indicators. And the P&L indicator is the most important of the bunch. So let's say you've got a steady uptrend like this. What I don't like about this is a deceleration ramp visual pattern. It was all hot for a few days. That doesn't translate into you're going to make money with it necessarily because they are putting the brakes on. It's like here in Colorado, the speed limit is 75 miles an hour, which I love because I grew up in California where it was I can't drive 55 on the 405 and the 91. Drove me up a freaking wall. So I like the 75 miles an hour we can go in California or in Colorado here. But if I go to California, I got to go 55 or slower. A deceleration ramp where you've got a good sharp 45-degree angle classic breakout, kind of like a logarithmic curve that's getting a slower excitement, especially with the divergence of volume going down, that will more likely kind of screw you on the new breakout. So this would not be a good entry, certainly not at 17.8 and dubious at say 18.25. That would be my official, though not a trading recommendation, that would be my official entry where I would buy would be 18.20. Now, because it's a breakout but in a deceleration kind of divergence pattern, I'll use a smaller share size. One of the critical decisions that you need to make as a professional trader is to determine whether or not you go at least binary, heavy or light share size. If it's all systems go, you know, like my long calls in PayPal were, or NVIDIA, even back in the day, I was calling this guy long back when I was 38 for my traders, right? That was my first long call here over this, or first was at the cup pattern high, then second after this green candle. I was calling this long for my traders last year. Okay, that's all great, and it kept running on up. The biggest challenge that you face as a retail trader and trading breakouts is that it looks expensive. But hey, I'll buy 80 and sell 160 all day long, right? Every penny I got, I'll buy $80 a share and sell at 160. Though 80 undoubtedly looked really expensive to people who were erroneously. So you got to fix what's going on in your head as a trader. You know, the punchline is that looked expensive to everybody who was looking down here the wrong place. You guys were looking down here and saying, it was a $40 stock. No way I'm going to pay 80 a share for it. Well, permit me to disagree, to quote Pulp Fiction. Allow me to disagree, whatever. If it's in a strong uptrend and you got a good breakout in volume, it's always likely a good breakout trigger as long as you add a false breakout filter to stay out of false breakouts. So you're not in a fake out and it continues on up. So those type of charts make sense to engage with. It's what a Wall Street traders, my institutional clients use more colorful language. I'll keep it G-rated and just say it's in play. but they use more colorful words. Anyway, the thing that you want to look for are these kind of charts that are likely to make success for you regardless of where you put on the trade or regardless of where you get in. It's got a continuous uptrend that's very tight channel, large percentage of green candles compared to red candles. Price action gets off its tail and actually runs up every week or so, and it continues to take out new highs. So those are the kind of charts that, at least as a professional trader, I like to focus my energy on. So question, what's the, another question designed to make your eyes glaze over. No, just kidding. What's the percentage range on this chart if we round from 30 to say 36? What percentage did this chart go up? Okay, I won't keep you in suspense. Let's call it 20%, right? 0.2 times 3, 20% is 6 points of range. It went from 30 to 36. That's double the volatility that I require. Before I put on a trade, I want, again, at least 10% range. This range is vastly underrated by traders. Most of you guys are trading crappy charts that don't go anywhere because you read about it or you saw some guy say, booyah, on some financial news. Like, I was dog on AT&T. I have since 1999, and it never ceases to fail. It's a horrible chart to trade. Anyway, this thing does not have much range. It's not a smart chart to trade. Charts, on the other hand, that are clean and tight make a lot more sense, especially when you see minor gaps that continue. Now, from a scaling or position sizing and dynamic standpoint, I like to scale in or add to a trade every 2 points. It's on one of my YouTube videos, I said trade wide, not deep. What I mean by that is it's a lot smarter. I even said this back in one of my Money Show interviews with Tim Berkwin that I have known since the dawn of time. Great guy. Anyway, he founded the Online Traders Expos back in the year 2000. Back when we were talking I said pilot trades, and I stand by that. It's much smarter, by the way, from a trade management standpoint. I found in my own real money trades to do, say, a dozen trades that only say 50 or 100 shares each rather than 3 trades of 300 shares each, because you diversify your risk. So for the inevitable half of the trades that don't work out or go sideways or really don't pop much, you can tighten in a trailing stop or go to cash, get your cash back out and rotate it from a capital rotation standpoint, capital allocation into something that's running. But it's a lot smarter, for example, if you had, say, $1 million to trade, it'd be a lot more sensible to do, say, 100 shares of all these guys rather than just try and cherry pick 2 or 3. Because cherry picking charts is an exercise in failed futility. It does not work. If you're a trader and you know who you are, I always get nervous laughter at my Money Show appearances when I say this, where you have to conceal your trading losses from your spouse or your pet chihuahua, like an addiction. That's wrong. Stop the madness. There's got to be a better way. If you lose money as a trader, stop it. You have no business trading live real money unless you can at least double a paper trading account. If you can't at least, I tell my traders this, if you can't at least double a paper trading account, like an IB, I use Interactive Brokers, a $1 million IB account or whatever, if you can't take 6 months or a year or be patient, maybe a year or two, to double a paper trading account, you have no business trading live money because you're just going to waste your money. Instead, invest your money in education from trusted educators who are people that are widely respected in the industry, right? And I'll let you be the judge if you want to include me in that list. Thousands have, but that's your call. And then folks like Bennett and others who are really good educators and know what they're talking about. It makes a lot more sense to spend your money on education from reputable sources and use that as the starting place, kind of like a beta test or a sandbox. Like software developers know what I'm talking about. You got a sandbox, you're trying to test things out. Do it for free first, or at least, say 5 or 10 share trades or single lot or single contract trades, depending on what instrument category you trade. But you have no business trading live capital until you can at least show a consistent profit paper. That would be common sense. And yet how many people don't listen to that? They're off trading penny stocks or low float $3 pop and drop crap stocks, and they blow up their trading accounts and they wonder what happened. And the answer is not, spend more money on that kind of trading. The answer is learn the strongest charts that actually work. Like Weight Watchers. This one's going on a diet, right? Shwang, Ken's World Party on. That's a good technical indicator. The Shwang indicator. I digress. I like to have fun with this. So many tens of thousands of people I taught. Ching. This is what pattern and acceleration ramp. You got a steady uptrend that matures into a sharper angle breakout over a sustained time frame of several months. Look at your charts like employees that you're going to hire. You're going to want to trade. You're going to want to trade charts and hire people that are authentic. They have integrity. They have consistency. They're reliable. They're people that you can trust. Those are the kind of people I like to work with. Everything else ends badly. I learned that the hard way with both women and with colleagues. You find like Diogenes with the lamp. You're looking for honest people. Well, as a trader, you're looking for honest charts that you could have pretty much thrown darts at it. Maybe you would have gotten screwed if you tried to trade here or here. But other than that, it would have worked out nicely. So you could have thrown darts at Weight Watchers the last few months and come out nicely ahead. This thing, oh, I don't know, only doubled, right? It went from 14 to 28. You're not going to see this consistency. The thing why I'm on a big rant about penny charts is that, you know, morons trade those because, I don't know, let's just look at today's leaderboard. I will prove this. I have no idea what the leaderboard cheap stocks are because I don't trade them, but let's look at our percent gainers, look at some cheap charts. That would have been a stupid chart to trade. That would have been a stupid chart to trade. Cheap charts are cheap for a reason, like O'Neill said. You know, pop and drop charts are, I guess, more accurately if we look at the daily intraday chart. These cheapies are really stupid to trade. Don't be seduced by the dark side, Luke. And don't be seduced by penny or crap stocks because you're just going to get in trouble. Stop the madness. These kind of charts are foolish. You'd have to trade thousands of shares to try and scalp a few pennies. So hopefully I'm preaching to the choir. The better charts are ones that, like people that you trust, are more consistent over time. So you don't have to thread the eye of the needle. You know, let's say a trader, oh, I'll go 10,000 long here, I'll get stopped out. It runs up without me. Okay, I buy up here because now it's surely going to break out. And then you get stopped out. You know, stop that. Just stop trading cheap charts. You're just going to get in trouble. It is so much smarter. This is a bullish engulfing, so actually might be okay on a pivot, but bada bing. The point is it's much smarter to trade, say, 100 shares of a $50 stock than 1,000 shares of a $5 stock, though the capital outlay is the same. The numbers don't add up on cheap charts because you have to absorb a lot of front-end risk, and then you get stopped out more often than not, and that chews up your trading account. I inherit countless legions of traders from these penny stock and cheap stock chat room operators, mostly young kids who don't know any better, and they're day trading with money they don't have, and they try and trade cheap charts. You want instead charts like this that you don't see in the largely in the under $10 category. You don't see consistent uptrending charts like Take Two Interactive, Schwang, gap continuation. Said I beg to disagree, and I come back down, found support. Now it's taking out new highs finally. This is Take Two, Weight Watchers, ZTS. Another quick rule of thumb, and all of you are professional traders. I know some of my institutional guys might be in here. The tighter the trading range, the better the chart. The more clean, kind of like a piece of yarn or dental floss that's been tied tightly. I stopped getting root canals when I started flossing just a few years ago. Amazing, the correlation. Read the freaking manual for life. Well, as a trader, you need to read the freaking manual and trade good high velocity breakouts. So things with a nice clean, kind of like a magnifying or a pair of binoculars or a DSLR camera that's sharply in focus makes it a lot easier to trade these than charts with big pullbacks. And yeah, this is being recorded. Thanks, Wendy. So see how this chart is a rock star? Now, newbie traders would be saying to themselves, well, I'm late to the party. It's gone from 14 to 28. Remember my NVIDIA example? Or if you look at Disney, I'm a Disney shareholder. I started going back to cash a few months ago, but this thing had been such a good breakout for quite a long time. Disney's a good long-term example of a good performing chart that's now pulling back. Anyway, this thing ran up for 3 years in a row, right? So don't underestimate the power of a trend, but the key is you have to trade instruments that have good high volatile or high velocity breakout patterns that are moving up. Another pattern, especially for those of you who are doing shorter term swing trades, this is the 3-month, is to look for pivots off the 50 EMA. If you see, this would be better if it was a bullish engulfing or hammer, but if you see a sell-off chart that bounces off of 50 EMA, that's often going to provide a bounce. You may want to give it a few days before you get in, but they often provide good trade setups. And if you look on the 1-year chart, you can see the spectacular meteoric rise in Weight Watchers going from 9 to 28. Now, the thinking, the difference, I'm almost out of time here, so we're going to wrap up soon. And thank you all for being here. This is lessons learned the hard way for real money trades I've done over the years. Newbie traders might say, well, why am I going to pay 28? I'm going to wait for it to go back down to 19. Well, good luck with that, Sparky. Or they'll say, why am I going to pay $28 for something that some other guy got for $10 a share, 6 months ago? Why am I going to pay up for it? Well, because it may keep going up to 40 or 50, right? Like NVIDIA or others. And maybe this is the top, but so far, buyers are firmly in charge of this. It may look kind of bubbly here like a bubble stock, but it's still a technical strong breakout, right? It's large preponderance of green candles. So I'm not saying to necessarily go long and buy this thing now, but if it does continue on up, personally, when something gets close to a decade value, I will hold off. So personally, I'm going to wait until this guy breaks over 30. So that's another quick tip, is never buy nines. And if you're doing a longer term swing, a strategic swing, which may be for a month or two, it's a smart idea to wait until it breaks clear over the 30. Now, and again, I don't buy 30.1 because I'm going to anticipate a false breakout. The 30.5, 30.7 may be a smart place to get on board this guy. Again, not a trading recommendation if it keeps going up, or some of these others. Like this is a bearish engulfing, so we certainly don't want to buy here. Inconceivable. You keep using that word. I do not think it. For the fellow Princess Bride fans, one of my favorite movies, along with Wizard of Oz. Oz the Great and Powerful, a fantastic Disney adaptation of the classic. I digress. Anyway, this guy'd wait till 64.50, 50 cents above the nearest whole number. I don't want to touch this because it looks like it's going to drop. We got a shooting star and a bearish engulfing. That doesn't portend well for longs. Let me ask a quick kind of a final question before we wrap, gang. No more than 2 points trailing and initial stop should be used for swing trading charts in the $20 to $70 a share range, as you may have seen in my stocks and commodities articles, which I kind of repeat those risk management numbers often and hope that it'll sink in and people actually start making money. So, loss of the nearest whole number. Where would you guys, you can always tell good traders by how tight their stops are. I've trained so many thousands of traders and so many hundreds in person. The professional guys, the market makers or the specialists always use super tight stops. And the brand newbies who've been losing their accounts and getting their head handed to them always use big wide stops. They'll say, well, I don't know, there's a support line back here. Maybe I should use 58 for a swing trading. No, just I don't know, go buy a mutual fund if that's your thinking. A trader is all about the money. Where would you guys stop out? Where would you guys trail a stop? Let's say you're long ZTS here. And it's been a great ride. It's been a great story. It's been like a great first date. It's got the beginning, the middle, maybe an end here. Where would you trail a hard stop on this guy if you were long ZTS? Go ahead and type your answer right now. And again, the good traders are going to use a tight stop, the bad traders not so much. Or they won't know, they'll guess. Or even worse, they'll trade without a stop. If you've traded without a stop, shame on you. You know who you are. I used to be like that too until I blew up 2 trading accounts back in the 90s. So I learned the hard way, that doesn't work. What you got to do is risk management's everything, right? So thanks, Aaron, Dan, Mike, Wayne, Alex. Yeah, I would use a loss of the 62 would be the whole number price region that would prove the trade wrong. So a clever trader, I use right under. So I'd use 6180. Sell stop limit order 6180, limit 61 would be my sell order on this guy. So if you got in somewhere in the 50s, congratulations, you're in the money. Alex, tell them what they won. You've won an all-expense paid trip to looking at a chart. So anyway, a loss of the 62 is a good reason to get out of the trade. So anyway, y'all have been great. Thank you so much for being here. I'm Ken Calhoun. I hope that this starts clarifying some of the difference between what's worth trading and what's not, and the difference. Take a look at learn from people that know what they're talking about, whether it's Bennett or myself or other colleagues, the people that are sharp cookies. We've been around for a long time. We know the mechanics, the ins and outs of the trades. The punchline is it's still up to you, and you have to figure out which entry patterns to trade make sense for you personally. What are your stops, targets, and exit signals? Use price projection and price action and volume to help you navigate that. What's your personal success plan and what next steps are you going to take? So again, if you want to get involved with me, you can. I've got as of February, we're up over that now, but I had 4,366 registered for my free week aheads. I've been doing these for years. Been meeting every single Saturday since the dawn of time, it seems like. Anyway, you're welcome to participate. You can go to trademastery.com/free or just go to trademastery.com and click on free. Either way, you're in good shape, and I'll look forward to seeing you in the Saturday freebie events. My market week ahead, we go over swing trade and day trading charts. I didn't have a lot of time for day trades today, but anyway, I hope that helps you guys make better trading decisions more often. So thanks so much. I appreciate it. All right, TJ, I agree. You guys have been great to work with. Oh, thanks, Dragon. Dragon, what's your name? I'm opening this up. Dragonfly Dozy. Thanks, Dragonfly. Great stuff. And no, I'm not going to buy Disney now because it's not in an uptrend. I like to buy uptrends. That's what I do. That's what I do for a living. I buy uptrend continuations with buy stop limit orders, by the way. I never want to buy like a 6-point gap up, so I don't use blind buy stops. I use a buy stop with a 1-point limit on top of it for swings. For day trades, it's live, so I just use buy stop orders or hit it at market. So anyway, thanks so much for being here. And on behalf of all of us here at Trade Mastery and my colleagues that I work with and trust, like Bennett at traderscoach.com, 2 websites, bookmark them. Go to traderscoach.com and go Control B on your keyboard. That will bookmark the site. Then go to trademastery.com, Control B. You know the routine. You've been there before. Bookmark the site, and we will see you guys in our various educational services. So thanks to Bennett and to Gene, too, for all the help and working together, and I will look forward to seeing you guys in our next event coming at you. We will be sending out the downloadable link to this. It'll be in the GoToWebinar. We'll send a follow-up email, and I'm going to put the recording on I'll put it on YouTube later tonight, but I'll also put it on my Amazon S3 server, and that'll be the link that you'll get in the automated GoToWebinar follow-up email, so you can download it and keep it. So it'll be a high-resolution WMV video download that you can keep and refer to in the future. So thanks, everybody, and I'll see you guys in our next event. Goodbye, all.